Insurance fraud and the management of insurance fraud risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses insurance fraud and the management of insurance fraud risks. In this video, you will understand the meaning of fraud, why people commit fraud, fraud triangle, insurance fraud, impacts of fraud on insurance business, profiles of fraudsters, classification of insurance frauds, types of insurance frauds, strategy for managing insurance fraud, policyholders and insurance fraud risk management process, pitfalls in insurance fraud risk management, and reduction of insurance frauds by insurers. Now, let us start. What is a fraud? Fraud can be described as an act or omission intended to gain the dishonest or unlawful advantage of the party committing fraud or other related parties. In the case of insurance fraud, this would usually involve an exaggeration of an otherwise legitimate claim, premeditated fabrication of a claim or fraudulent misrepresentation of material information. Fraud poses a severe risk to insurers and policyholders. Fraudulent activities committed within or against an insurer can adversely affect the company's financial soundness and reputation. Insurance frauds indirectly impact policyholders by increasing the premium payable due to increased claims handling costs and payment of fictitious claims by insurers. Insurance regulators should take a severe view of fraudulent activities and ensure that all insurers undertake sound risk management practices to effectively deter, prevent, detect, report and remedy insurance fraud. Why do people commit fraud? There is no single reason for committing fraud, but there are several reasons why people commit fraud. Reasons why people commit fraud include: 1. The motivation of potential offenders. 2. Opportunities to commit a crime. 3. The technical ability of the fraudster. 4. Actual consequences of discovery fraud activities. 5. Expected and actual risk of discovery after the fraud has been perpetrated. 6. Conditions under which people can rationalize their prospective crimes away. 7. Expectations of consequences of discovery, including non-penal consequences such as job loss and family stigma, proceeds of crime confiscation, and traditional criminal sanctions. Fraud triangle. A typical model that brings together various aspects of fraud is the fraud triangle. The fraud triangle model advocates that fraud results from three factors: financial pressure, opportunity, and rationalization. Let us consider the three components of a fraud triangle. 1. Opportunity. Opportunity is a significant factor influencing people to commit fraud. Examples of an insurance company's mechanism that may induce fraud include a weak internal control system, poor security over company property, and not having trusted and responsible key bank account signatories. Hence, insurance companies and related firms should enhance the quality of their activity and operations. 2. Financial pressure. Financial pressure is another factor influencing people to commit fraud. Examples of the financial pressure that can motivate people to commit fraud include gambling or betting habit, problems from debts, including threats on outstanding loans, feeding and house rent, payment of children's school, and living a fake life. 3. Rationalization. Rationalization is another factor influencing people to commit fraud. People who commit fraud tend to present rationales for their fraudulent acts. For example, some people may rationalize their fraudulent actions based on poor staff welfare, take care of siblings after their parents' death, and temptation forms the devil. Insurance fraud. Insurance is a contract between an insurer and an insured whereby the insurer undertakes to indemnify or compensate the insured, in exchange for payment of the premium, in the event of losses or damages insured. Insurance fraud exists when individuals attempt to profit by failing to comply with the terms of the insurance agreement. Besides tax fraud, Insurance fraud is the most practiced fraud in the world. By its very nature, the insurance business is susceptible to fraud, but the extent of insurance fraud can be reduced through sound fraud management. Impacts of fraud on insurance business. The following are the potential impacts of fraud on the insurance business. 1. Cancellation of insurance policies. 2. Reduction of premium income. 3. Poor claims settlement which results in claims not being paid promptly. 4. Insolvency and winding up of insurance or reinsurance companies. 5. The poor rating of insurance companies by independent third parties. 6. Poor corporate governance. 7. Loss of business confidence and customers' patronage. 8. Negative impact on staff morale. 9. Weak organizational risk culture. Profiles of fraudsters. There are two general profiles of fraudsters, opportunity and professional fraudsters. 1. Opportunity fraudster. An opportunity fraudster is usually a law-abiding person who sees an opportunity to commit fraud. For example, this type of fraudster might imagine that insurers have limitless funds and might find it acceptable to make up claims to recover the costs of premiums paid in previous years when there have been no claims. Concerning internal fraud, the fraudster might, for example, falsify expenses or the financial accounts of an insurer for his/her benefit. 2. Professional fraudster. A professional fraudster earns or complements his/her income by committing fraud. He or she may continue committing fraud until detected and may target several insurers. An extension of the professional fraudster profile is an organized crime involving a group of persons capable of committing complex and extensive frauds. The fraudulently obtained funds may be used to finance other criminal acts. Classification of insurance fraud. Fraud comes in different shapes and sizes. It may be a simple act involving one person, or it may be a complex operation involving many people from within and outside the insurance company. Insurance frauds may be categorized into three based on the person or entity who perpetrate a fraud. 1. Policyholder claims fraud, 2. Intermediary fraud, and 3. Insurance companies frauds. 1. Policyholders claim fraud. This includes frauds perpetrated by insurance policyholders, wholly or in collaboration with third parties, against insurance companies. 2. Intermediaries fraud. This includes fraud perpetrated by intermediaries against the insurer, policyholders, customers, and beneficiaries. 3. Insurance companies fraud. Illegitimate insurance companies and dishonest insurance agents can defraud consumers by collecting premiums for bogus policies with no intention or ability to pay claims. These companies may offer policies at costs that are significantly lower than the traditional market price to attract consumers who are trying to save money. In many cases, a fake insurance company will provide consumers with documents that look real. In other instances, these policies may even be represented by legitimate insurance agents who themselves have been misled by fraudulent companies. Insurance frauds can also be classified as hard and soft frauds. Hard fraud occurs when a policyholder deliberately destroys property with the intent of collecting on the insurance policy. Soft fraud, which is more common, occurs when the policyholder exaggerates on an otherwise legitimate claim or intentionally omits or lies about the information on an application to obtain a lower premium. Soft fraud is often considered a crime of opportunity. Having discussed the classification of insurance fraud, let us proceed to consider types of insurance fraud. Types of insurance fraud. Insurance fraud can occur during any stage of the insurance transaction by any party involved. This means that applicants, policyholders, third-party claimants, professionals who provide services to claimants, insurance brokers or agents, even companies, may attempt to commit some insurance fraud. Insurance fraudsters have found many ways to take advantage of people. There are several types of insurance fraud. The 8 most common forms of insurance are insurance application fraud, claims fraud, fake death frauds, false claims fraud, inflated claims, forgery and identity theft frauds, false police reports, and insurance company frauds. Let us discuss these 8 types of insurance frauds. 1. Insurance application frauds. May people knowingly lie or provide incorrect information in an insurance application. This is application fraud or material misrepresentation. This may involve any class of insurance. Someone who provides false health information while applying for medical insurance or life insurance, for example, has committed application fraud. Another person might apply for auto insurance and fictitiously claim far above the worth of actual damage. Similarly, another applicant might apply for renter's insurance and double the value of their possessions. Because the cost of a life insurance policy is contingent upon a person's health, age and more, people may lie about their smoking habits or general health to receive a policy at a lower cost. It is, however, necessary to emphasize that application fraud only applies to intentional lying or unintentional misrepresentation. People get things wrong on their insurance forms all the time due to an honest mistake, higher estimate, or other error sources. It is not fraud to estimate your weight on a medical form and get it wrong. It only becomes a problem when you intentionally make a false claim. It is, therefore, essential to be honest when applying for insurance. 2. Claims fraud. One of the most common types of fraud is claims fraud, which occurs when a policyholder makes a claim that never happened or was caused intentionally. It can also occur when work was never completed or performed. There are several reasons and ways this type of fraud can occur. For example, slip and fall claims can be staged events. Fraudsters choose this type of fraud because injuries are usually challenging to disprove or prove, and the potential payouts are typically high. Those trying to commit claims fraud may also damage their car, which they own outright. Once they receive the money from the claim, they may either decide to have their car repaired inexpensively or not get it repaired at all. Homeowners may also attempt this type of fraud by damaging their property for a claims payout. Another example is when a property owner has a building worth a lot less than the value on the insurance policy. Therefore, the policyholder may hire someone to commit arson to make it look like an accident to receive a higher payment amount. Some homeowners or business owners facing bankruptcy may also try this type of fraud to rid themselves of their mortgage or other business debt. 3. Fake death frauds. Another type of claims fraud is known as death fraud. This occurs when a policyholder fakes his or her death to receive the life insurance payout. While it may seem like something a person sees in a book or movie, it does happen in real life. Conversely, a beneficiary may attempt to murder the policyholder to receive the entire payout. When someone plays dead and tries to file an insurance claim, it becomes a felony. Often in this scheme, their beneficiary will collect the money and share it with the claimant. The reality is that it is difficult to get away when the life assured faked its death. Although this is rare, the insurance company may not pay the claim to any beneficiaries if the death was due to a homicide. If someone's life insurance beneficiary kills them, the murderer loses all rights to the money. 4. False claims fraud. False claims fraud occurs when people invent their claims. Perhaps the most common form of false claim fraud is when someone causes accidental damage themselves and tries to file an insurance claim. For example, an insured might accidentally hit a tree while backing out of a driveway. It would be a fraud if the insured files a claim that it was a hit-and-run claim. False claims fraud entails a broad range of activities. Examples of false claims fraud include 1. Staging an accident or injury to file a claim against someone's insurance deliberately. 2. Filing a claim for an injury, accident or other forms of an incident that never happened. 3. Filing a claim with false information. 4. Intentionally creating damage to file a claim. This is the motivation behind many arson cases, in which a building owner will burn down a worthless structure to try and claim the insurance money. 5. Filing a claim for damage that does not exist. This is common after significant storms when people who did not have any damage will file a claim and hope that the insurance company is too overwhelmed to investigate appropriately. 5. Inflated claims. When a natural disaster devastates an entire region, fraudsters attempt to take advantage of the insurance companies. In some cases, homeowners in need of work to their home may sign inflated claims knowing that the repair work was never done. In other cases, homeowners might submit a claim but are unaware that the work was never performed. Some disaster insurance claims are easier to inflate than others, such as roof repair claims. Suppose a homeowner needs to submit a roof damage claim. In that case, the roofer may bill the insurance company for higher quality materials and then switch to subpar materials when completing the work. Inflation fraud is having the mechanic make upgrades to the insured's car instead of just repairs and then send the entire bill to the insurance company. Inflated fraud is a doctor charging a couple's health plan for some tests that are not run or unnecessary. The slip and fall claimant says that they cannot move their arm and then goes out for a tennis game the next day. 6. Forgery and identity theft frauds. People sometimes try and file claims under someone else's insurance. This is particularly common with health insurance. Individuals will get another person's identifying information and then try to make claims against their insurance. Sometimes these are illegitimate claims for legitimate treatments, but often this is simply a way to defraud insurance companies. For example, one common scam is for criminals to steal the identities of elderly citizens on Medicare. Then they will order expensive medical equipment using the stolen identity, have it paid for by that person's insurance, and resell the medical equipment for a profit. 7. False police reports. Many forms of insurance fraud involve filing a false police report. Any accident involving a moving vehicle, stolen property, burned or intentionally damaged should involve a report with the local police. Most insurance policies will require that the policyholder submit a copy of the police report along with any relevant claim. For example, suppose the insured laptop is stolen. In that case, the policyholder needs to report the theft to the local police and get the appropriate paperwork before paying the claim by the insurance company. This is a bottleneck for many forms of insurance fraud because filing a false police report is a crime. In most, if not all, states, it is punishable with jail time. It gets the police involved with the scam. 8. Insurance company frauds. Insurance fraud does not always come from policyholders or others trying to take advantage of the insurance company. This practice is widespread. It involves practices such as sending patients a bill for services that their policy unambiguously covers, automatically denying claims, inventing pretextual reasons for denying or underpaying claims. Sometimes, insurance companies try to take advantage of consumers. Here are some of the most common insurance fraud scams you should be aware of. 1. Selling phony insurance policies. An agent or insurance company representative may attempt to sell fake coverage through an illegitimate insurance company or try to sell fake coverage using a legitimate insurance company's name. 2. Selling coverage you do not need. Agents use several tactics to sell consumers coverage they do not need. Some fraudsters use a sliding tactic when an agent adds additional coverage and claims that it is part of the policy. Fraudsters sell other coverage options, including motor club memberships, accidental death coverage, and guaranteed renewable life insurance. 3. Stealing of insured's premiums. Some agents may request that policyholders send premiums directly to them and divert the payment amount without remittance to the insurance company. 4. Pushing a product deceptively. Some agents may push consumers to buy an insurance-like instrument like a viatical settlement, which is a way to make money out of an insurance policy on sick or terminally ill people against insurance practice guidelines and regulations. Strategy for managing insurance fraud. An insurer should have a sound strategy to manage fraud risk arising from its operations. A sound and prudent fraud management strategy should be compatible with the risk insurer's profile. The fraud management strategy should form part of the insurer business strategy and be consistent with its overall mission, business strategy and objectives. Hence, a sound fraud management strategy should 1. Ensure that an insurance company mission statement should be clearly articulated to show that the insurer has a zero tolerance for fraud. 2. Facilitate the development of quantitative risk tolerance limits on fraud. 3. Provide direction to the overall fraud management plan, and 4. Reflect its risk profile and vulnerability to fraud. To enhance insurers' risk profile and reduce their vulnerability to fraud, the following factors should be taken into consideration. 1. The company's size, composition, and volatility of its business. 2. Its organizational structure. 3. The complexity of its operations. 4. Products and services offered. 5. Its remuneration and promotion policies. 6. Its distribution modes, and 7. The market conditions. Policyholders and insurance fraud. Some insurance policyholders may have a fraudulent intention, hence insurers should integrate appropriate checks and balances into their operations. Common indicators for identification of policyholder and claims fraud include 1. The policyholder has been declined coverage by other insurers due to reasons such as non-disclosure or false disclosure of material information. 2. The claimant is willing to settle claims for an inexplicably low settlement amount in exchange for a quick resolution. 3. Claimant provides inconsistent statements or information to relevant parties such as the insurer or police, and 4. The claimant made several claims of similar nature within a relatively short period. Insurance fraud risk management process. An insurance fraud risk management process consists of three stages involving fraud risk identification, control, and monitoring. Insurers should assess their business activities and internal processes for any vulnerability to fraud and determine the consequential impact of any potential frauds. Let us discuss the 3 stages of insurance fraud risk management. 1. Insurance fraud risk identification. The insurer should recognize that certain products and lines of business may be more susceptible to specific types of fraud. Hence, the need to identify fraud risk factors in product design at the early stages of insurance products development. In determining the potential sources of fraud risk, the insurer should consider the following. 1. Adequacy of measures to verify customer information before accepting a customer's proposal, taking into consideration the risk factors posed by different distribution channels, such as online policy applications without face-to-face contact, and 2. Fit and proper standards for its intermediaries to avoid insurance frauds. Common indicators for identifying fraud risks. The common indicators for identifying fraud risks are 1. The insurer must establish appropriate indicators that suggest a higher risk of fraud when triggered. 2. If one or more indicators are triggered, the insurer should ascertain the facts to determine whether a more in-depth investigation and follow-up actions are warranted. 3. There should be adequate documentation of the verification actions taken. The indicators should be reviewed regularly for their continued relevance and effectiveness in detecting fraud. Insurance intermediaries play essential roles in insurance business marketing and operations. Examples of intermediaries are insurance brokers, loss adjusters, risk assessors, surveyors, and property valuers. Intermediaries may be involved in insurance frauds. Common indicators for the identification of intermediary fraud include 1. Evidence of churning of policies either within the insurer or across several product providers. 2. Many policies in the intermediary's portfolio that have arrears in premium payments or unusual product-client combinations, such as instances where the policyholder's income is not likely to be able to support the premium paid for the product or previous frauds. 3. Customer complaints against the intermediary, including the mishandling of monies and non-receipt of policy documents from the intermediary after the insurer has issued policy documents. 4. Customers' records are not in the insurer's customer database even though proposal documents or payment was provided to the intermediary some time ago. 5. Indications that suggest that the intermediary is in financial distress. 2. Insurance fraud risk control and mitigation. An insurer should establish an adequate client acceptance policy, including categorization of usual product-client combinations. For example, an insurer may categorize its customers based on expected earnings and other factors for specific products to identify unusual product-client combinations. For each combination, the insurer should set out clear conditions to accept clients' proposals and measures to detect and mitigate insurance frauds. A typical client acceptance policy should entail: 1. Customer due diligence measures should be taken before a business relationship is established for various product types, and 2. Operational measures to take care of unusual product-client combinations, including the request for additional supporting documents. To minimize the risk of intermediary fraud, insurers may adopt the following measures where appropriate. 1. Ensure that policyholders' information such as mailing addresses are not altered without proper authorization from or verification with the policyholders. 2. Send policies and documents as well as payments directly to policyholders rather than through intermediaries. If this is not possible, insurers should, at a minimum, send a separate notification to the policyholders if policies and documents, as well as payments, are dispatched via the intermediaries. 3. Prohibit intermediaries from accepting premium payments in cash. If this is unavoidable, payment receipts should be issued by the intermediary. 4. Encourage policyholders to make all checks payable to the insurer only and take additional precautionary measures such as indicating the policy number, for renewal policies, or the proposed policyholder's name and policy number at the back of the checks. 5. Enhance the monitoring of an intermediary's insurance policies and those of his immediate family members when there are grounds for suspicion. 6. Avoid issuing checks in favor of parties other than beneficiaries of the insurance policies. Should the insurer decide to accommodate a policyholder's request to issue checks made out in favor of a third party, the insurer should ensure that it has exercised due care to authenticate the authorization given by the policyholder to issue the third-party check. 7. Enhance monitoring of checks received through an intermediary issued by third parties who are unrelated to the intermediary to pay for policies owned by the intermediary or his immediate family members when there are grounds for suspicion of fraud. 3. Insurance fraud risk monitoring and review. An insurer should establish and maintain an incident database containing names of staff or their immediate family members, policyholders, claimants, and other relevant parties who have been convicted of fraud or have attempted to defraud the insurer. The Association of Insurers in the Market, for example, Allied Insurance Group, Canadian Insurers Association, Nigerian Insurers Association, and British Insurers Association, should also collaborate to establish an industry-wide database to facilitate the sharing of fraud-related information among industry players to enhance insurers' ability to identify potential fraudsters and fraudulent transactions at an early stage. An insurer should monitor the performance and trend of business introduced by intermediaries to the insurer to detect any indication of intermediary fraud. For example, should the actual level and pattern of business accepted by the intermediary differ significantly from the intermediary's track record and projections, this may warrant verifying whether there are legitimate reasons for the disparity. An insurer should carry out periodic fraud-sensitive independent or internal audits to ensure compliance with its policies and procedures regarding insurance fraud risk. For instance, such checks should include verification that whenever fraud risk indicators are triggered, they are consistently and adequately dealt with and adequately documented. Pitfalls in insurance fraud risk management. Insurers should regularly improve their operations, including underwriting and claims handling processes, to enhance their competitiveness and fraud management capabilities. Common pitfalls in the fraud management capabilities of insurers may be classified into 5 broad categories. 1. Not in the focus of top management, many insurers view fraud management more as a specialist than a top management topic. They also often assume that the share of potential fraudsters is below average due to careful underwriting and application checking processes at their own company. This often results in a high tolerance in a claim, even if statements are contradictory. In most countries, it is the exception rather than the rule for fraud management to be positioned as a top management issue in the interests of customers who are honest. 2. Limited importance of fraud in operational claims processing. Usually, a clear focus on fraud management lacks. Individual claims organizations and staff barely exchange notes. Alongside tools for the automatic recognition of fraud, systematic manual recognition via checklists, fraud manuals, or the like has proven especially effective and can be implemented fast. Claims handlers responsible for manual fraud detection are often under heavy pressure from the high efficiency demands they come under from their claims departments. The principle of having one claims file processed by several clerks is often the norm, too. Both techniques make it harder to recognize and fight fraud effectively. Even comparatively simple aids such as checklists or lists of guidelines can lead to considerably better results without increasing the workload. 3. Insufficient specialization. Suspicious cases are sometimes processed by fraud specialists who work as regular claims handlers and specialists. 4. Usage of obsolete or inadequate information technology systems. Most insurance companies use information technology systems to identify suspected fraud cases. But often, they are outdated and not regularly maintained. 5. Obsoleted investigation methods. The success of fraud investigators depends not only on specialization, but also on the choice of investigative methods. Cognitive interviews are examples. These specialized interview techniques can be used to determine the credibility of claims reports with great economic success. The honesty of the issue can be evaluated through cognitive interviews, sophisticated interrogation techniques, and psychological principles. This is common in the United Kingdom and Southern Europe, but they are rarely used in many parts of Europe. Reduction of insurance frauds by insurers. Insurers can reduce fraud mainly by improving their fraud management. Generally, the Market Insurers Association assists in reducing fraud risks in three major ways. 1. Optimize the fraud detection process. 2. Introduction of a triage function. And 3. Establishment of extended investigation methods. Let us explain these three ways of reducing insurance fraud by insurers. 1. Optimize fraud detection process. Operations checklists and fraud manuals will help claims handlers to recognize claims cases that are suspicious manually. Practical experience shows that this can significantly increase the detection rate without any IT investment. Even within a company, claims handlers have different skills and abilities to detect fraud cases. A structured checklist or fraud manual can significantly contribute to learning from each other and achieving a more homogeneous and higher detection rate overall within the group. 2. Introduction of a triage function. This entails introducing a staged fraud management process using a triage, initial case assessment and decision on resource allocation, as the central decision-making point. The function uses the appropriate fraud strategy and, usually, a cost-benefit analysis to decide whether suspected fraud cases should be investigated. Together with the triage function, the triage specialist has three further tasks. 1. To gather information on the cases and assign them to the fraud specialists ready for investigation, depending on their segmentation, specialization and current workload. 2. The triage specialist is responsible for the continuous optimization of fraud detection using information and training of claim handlers. The triage specialist should also ensure regular improvement of guidelines and indicators of any existing information technology-supported recognition. 3. Responsible for the key performance indicator-based, KPI-based, measurement of fraud management success using case figures and the savings achieved along the fraud funnel and process. 3. Establishment of extended investigation methods. These methods might, for example, B. Cognitive interviews to assess the honesty of the interviewee. This involves analyzing the consistency of replies to varying or repeated questions on identical points. The evaluation also includes the memory of details and the liveliness of the description. Features of successful insurance fraud management. Insurance and reinsurance companies should enhance the quality of their fraud risk management. It is beneficial to consider these two critical questions. 1. How do I know if an insurance company has sound insurance fraud risk management? 2. What is the evidence of successful insurance fraud risk management? These questions can be used as the basis for ascertaining whether an insurance company has successful insurance fraud management. I would encourage you to personally brainstorm on those questions in view of the content of this video. Meanwhile, a successful insurance fraud management system should possess some features. Here are 7 features of successful insurance fraud management. 1. Fraud management should be the top management agenda. Optimizing fraud management requires a clear commitment to address and initiate the corresponding cultural change in the company and beyond the claims management. 2. Clearly define fraud and how it should be handled. The fraud strategy should determine how the company defines fraud and its consequences. It is necessary to agree on the strategy with affected departments. When should a case be categorized as a fraud? From what point onwards should no further goodwill be offered? When should a contract be terminated, and when should a police report be filed? These criteria need to be communicated clearly and consistently, both internally and to customers. 3. Develop processes, key performance indicators, KPIs, and roles, rather than making significant information technology investments immediately. Information technology provides excellent added value in fraud management, particularly in fraud detection. It should, however, be built on well-defined processes and KPIs, not on a critical path. Waiting to start optimizing fraud management until IT solutions are ready is neither technically necessary nor economically advisable because many manual initiatives initially require barely any IT support. Therefore, it is necessary first to establish or optimize the processes, KPIs, and roles and then apply these to derive the IT system requirements. 4. Pilot early in parallel to design. The new approach should be tested early in parallel to fine-tuning the design in a pilot project. This parallel testing of the new approaches can provide valuable company-specific experience for future fraud management in an iterative process that can be directly incorporated in the refinement of the concept. 5. Invest in skills/specialization and in-house fraud specialists. Fraud management has excellent economic potential, but this can only be tapped if investments are made in building up skills and sufficient fraud specialists. The focus should mainly be on effectiveness and not unilaterally on efficiency. Efficiency is indeed a key topic, especially in the back office. However, the corresponding use of resources is more than justified because of the economic value of effective fraud management. 6. Pursue continuous improvement. Fraud management is a highly dynamic topic. Professional fraudsters often quickly adjust their approach to the behavior of insurers. Companies, therefore, need to counter this by improving their entire process to ensure that they are equally swift to react, from investigating and detecting fraud to penalizing those involved. A key factor here is the constant exchange between triage and fraud specialists and claims handlers, giving each other feedback and recognizing changes early. 7. Optimize beyond the claims department or unit. Optimizing fraud management is essential, but not exclusively for the claims division. This should be coordinated with the underwriting, marketing and operations departments to entrench rigorous fraud prevention and overarching consequence management, including termination of contracts. Conclusion. Insurance fraud and the management of insurance fraud risks have been discussed in this video. Fraud is an act or omission intended to gain a dishonest or unlawful advantage for the party committing fraud or other related parties. Fraud poses a severe risk to insurers and policyholders. Fraudulent activities committed within or against an insurer can adversely affect the company's financial soundness and reputation. Insurance frauds also indirectly impact policyholders by increasing the premium payable due to high claims handling costs and payment of fictitious claims by insurers. We have established that opportunity, financial pressure, and rationalization are the significant factors influencing people to commit fraud. Insurance fraud exists when individuals attempt to profit by failing to comply with the terms of the insurance agreement. Besides tax fraud, insurance fraud is the most practiced fraud in the world. By its very nature, the insurance business is susceptible to fraud, but the extent of insurance fraud can be reduced through sound fraud management. I hope the video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.